Before our eyes, the geography of world trade is changing. For decades, the People's Republic of China was the undisputed center of production. However, now, as geopolitical tensions rise and labor costs in China cease to be competitive, the world is beginning to look for an alternative. And it is at this moment that the gaze of global corporations turns to Southeast Asia. The region, inhabited by over 650 million people, encompasses 12 countries and forms one of the most dynamically growing economies in the world. Singapore, Vietnam, Malaysia, Indonesia, and the Philippines, each of these countries has its own strengths. But one thing unites them: the potential to take over part of the global center of production and trade. According to data from the World Trade Organization, the share of ASEAN countries in global exports in 2010 was around 5%. In 2023, it had already exceeded 8%. That's more than Japan's share and almost as much as Germany's. Estimates indicate that by 2030, ASEAN could account for over 10% of global exports, becoming one of the three main trade hubs alongside the United States and China. Let's look at individual countries. In 2000, Vietnam exported goods worth $15 billion. In 2023, it was already over $370 billion. The production of electronics, clothing, and computer equipment has massively shifted to Vietnam. The country has one of the longest land borders with China and dozens of trade agreements, including with the United States and the European Union. Singapore, on the other hand, is in a completely different league. It is not a factory, but a management center, the brain of operations. Singapore serves as a regional financial, logistical, and technological hub. Despite having only 6 million inhabitants, its port handles more containers than the ports of Los Angeles and Rotterdam combined. Singapore is the point where goods from around the world converge before heading further, to Europe, America, or other parts of Asia. Malaysia, meanwhile, specializes in semiconductors, electronic components, and the automotive industry. Companies like Intel, Infineon, and AMD operate plants in this country. Between 2020 and 2024, investments in the electronics sector grew by over 60%. Malaysia benefits not only from friendshoring, but also from stable law, well-developed infrastructure, and relatively low operating costs. Indonesia, the largest country in the ASEAN region, is a different story. With over 270 million inhabitants, it has rich deposits of raw materials, including nickel, bauxite, and copper. The government in Jakarta is betting on a strategy of processing raw materials locally, instead of exporting them unprocessed. As a result, Indonesia is becoming a key link in the global supply chain for lithium-ion batteries, a technology essential for the energy transition. And finally, the Philippines, a country that was overlooked for decades but is now making a comeback. It has one of the youngest societies in Asia, with strong historical and political ties to the United States. The Philippines is becoming increasingly attractive for investments in business service centers, electronics, and semiconductor components. In 2024, the country exported electronics worth over $45 billion, more than Indonesia, and almost as much as Malaysia a decade earlier. But potential alone is not enough. The question is, can this region truly take on a dominant role in global trade? Although industry, infrastructure, and macroeconomic data stand out, institutional, demographic, and geopolitical factors are no less important. Southeast Asia is not developing in a vacuum. It is part of a balance of power where every move can shift the alignment of trade poles. One of the key factors attracting investors is demographics. Unlike aging Europe or China, many ASEAN countries have a young, dynamic population. In Indonesia, the median age is 29. In the Philippines, 24. In Vietnam, 32. This means not only cheap labor, but also a growing domestic market. The middle class in the ASEAN region is expected to grow from 400 million people in 2024 to 650 million by 2035. This internal demand is becoming increasingly important. Many companies are no longer producing in Asia just to export to Europe or the United States, but to sell locally. Indonesia, the Philippines, and Vietnam are countries where the number of smartphone users, e-commerce, online education, and private healthcare services is growing rapidly. This is the future market not only for manufacturers, but also for service providers. But the region has its weaknesses. One of the biggest challenges is infrastructure integration. Ports and highways are developing, but not evenly. Transporting goods between ASEAN countries is still slower and more expensive than within the European Union or North America. There is a lack of a unified customs system, common technical standards, and coherent investment policies. That's why mega-projects like the ASEAN Connectivity 2025 initiative, which aims to connect the region with railways, energy grids, and fiber-optic cables, are important. If successful, it could transform Southeast Asia into one of the most economically integrated regions in the world. The second problem is the quality of institutions. While Singapore is a global model of transparency and administrative efficiency, in many other countries in the region, bureaucracy and corruption remain serious barriers. In the 2019 Ease of Doing Business ranking, Singapore was second in the world, Malaysia 12th, Vietnam 70th, the Philippines 116th. Without improving the quality of governance, attracting the most demanding investments is out of the question. Geopolitics also shapes the region's future. Southeast Asia lies at the intersection of the influence of three powers: China, the United States, and Japan. Each of these countries is investing billions of dollars in infrastructure, the digital sector, and the arms industry. But each also has its own strategic interests. China seeks to heighten its influence through the Belt and Road Initiative. The United States promotes bilateral agreements, such as those with the Philippines and Vietnam. Japan invests mainly in railway and energy infrastructure. Each of these directions brings opportunities, but also risks of dependency. ASEAN countries are therefore trying to balance, accepting investments but avoiding clear political commitments. In the background of these geostrategic maneuvers, a battle for added value is unfolding. It's not just about who assembles a computer or phone. It's about who designs the chip, who writes the software, who owns the patent. That's why Malaysia and Vietnam are developing science parks, research centers, and collaborations between universities and industry. The Philippines is betting on technical education reform, while Indonesia is building new economic zones where taxes and regulations are far more startup-friendly. Another challenge is the energy transition. Industrial production requires stable and cheap energy sources. Meanwhile, in many countries in the region, electricity costs are high and transmission grids are outdated. At the same time, Southeast Asia is an ideal place for developing renewable energy sources: wind, solar, geothermal. The question is whether governments can create conditions for private capital to invest on a scale sufficient for industrial needs. Finally, a fundamental question must be asked. Will ASEAN become a community of real economic interests, or merely a loose collection of nations? If it manages to integrate markets, improve institutions, and maintain geopolitical balance, Southeast Asia could indeed dominate global trade. But this will not only be the result of cheap labor, but above all, of consistency, reforms, and investments.